Right, thank you. Thanks, Harvi. Okay, so we started our new section last week, which was financial systems, right? When it comes to a financial system, I'll give you a small recap, guys. Right. This is our new section, right? Financial system. Okay. So when it comes to a financial system, I explained it to you that we are having whatever the system is, what are the basic characteristics of a system. And then the financial system consists of like several components, including financial markets, financial institutions, financial assets and liabilities, etc. So then we came to discuss about financial markets. So these are the types of financial markets we got to know. We got to know what a capital market is, right? Okay. We got to know what a capital market is, what the money market is, commodity market, derivative market, insurance and foreign exchange. Types of markets we understood what are those, right? So basically money market is where the money is being traded for the shorter term, less than 1 year. And then capital markets is where you raise debt and equity finance for the longer periods, typically more than 1 year. Then we came to financial intermediaries. Financial intermediaries. So in a society, we understood that the basic economic question was like having lots of needs and wants and having scarce resources. Just like that, that's one perspective. When it comes to the other perspective, there might be parties in the society where they have surplus funds and where there are deficit funds. So there's clearly a mismatch. So these people have several options what they can do. Imagine like if you have excess funds and if you have deficit funds, there are options you can do. So I showed you that they can directly contact each other and ask for money. Then they can use organized financial markets like capital markets, like bond markets. Lenders and borrowers can use financial intermediaries. That is the most common option. Financial intermediaries. So what is this financial intermediation verse? Wherever a person or a party is having a surplus of cash, surplus of money, without the involvement of a person to like secure that and to say that it's quite okay to give this to person, they will be having a really high risk if they tend to give that on a direct manner. So if I have lot of theoretically, right? If I have lot of money, theoretically again, I can give that to a deficit party, but I won't give that to you or some other person directly. So if this person is not paying, that's the end of the story. So that is where the financial intermediation came up, typically banks. So what do we do? If we have excess funds, we just go into the banks and we just deposit them, right? We just deposit it in the banks. That's the financial intermediary. They will collate that and organize that and make a pool of funds and they will give that to some deficit parties, right? So we will be paid a rate of interest. So anybody who is borrowing from the banks, they will pay a rate to the bank. So the difference for the fact of financial intermediation, banks will keep as their own margin. That's how it happens. So functions of a financial intermediary: risk reduction, aggregation. Financial intermediation is anyway. aggregation, maturity transformation. So I told you, I might be having excess funds not up until eternity, but for a period of 2 months, let's say. For 2 months, I'm having excess cash. But any person sometimes having a deficit of money, imagine now he needs to build up a house. So he needs money for like 10 years, at least for 10 years to pay that. But I'm having money only for 2 months. So there's a mismatch. So financial intermediaries help to solve this problem, which is this maturity transformation, which is a lot of people like having excess cash for short term periods will be going and investing that money in the banks, where the banks will pool it together, aggregation, convert into maturity transformation and be given as loans for longer periods. Right? Those are the functions of the financial intermediary. Then liquidity surplus and the deficits. Liquidity means having enough cash to meet the short term debt obligations. Having enough cash. So this, if businesses, so businesses have receipts and payments like this when it comes to a business. So the main way through which businesses receive cash is through sales. Sales revenue. You can see the pattern of receipts, and then the payments, you have to make payments to the suppliers, you have to pay salaries to your staff, you have to pay electricity and other utility payments. So definitely there's a match in between these receipts and payments. Accordingly, there should be methods in which we should match this gap, right? So the financial needs of businesses vary and take a variety of forms, like working capital. Working capital means to carry out the day-to-day operations, which is for a period less than 1 year, and then wages, salaries and everything, again investment purpose. Let's say a business is there, so that business need money to carry on the day-to-day operations, and apart from that, if they need to expand, if they need to invest, or if they need to diversify, for such sort of long-term decisions as well, they need money. Third reason is suitable instruments for investing any surplus. So if you have deficits, how can you match? You can simply call the bank and arrange an overdraft facility. This section needs to become later. Medium term, you can do leasing. Long term, equity finance, debt finance, and mezzanine finance. What was this mezzanine finance, guys? Both debt function and the equity function being carried out, that is known as mezzanine finance. So this is in terms of a business. In terms of a business. If a business doesn't have money, what they can do? If a business has excess money, what they can do? They can invest, they can purchase medium term instruments, they can purchase another company, acquire, expand, diversify, whatever. If a company has long term funds. So, meeting the, I told you about peer to peer funding and crowdfunding as well. So, when it comes to the government, why are we learning about the funding requirements of the government? Am I trying to convince you and put you into the government service that you should be having a government job anyhow? Is that why I'm telling this? No. Then, when you take a financial system, believe it or not, government plays a crucial role. Why? Why government play a crucial role when it comes to a financial system? What is this? What was the previous lecturer teaching you? Which subject? Did you use it? Then who? Poor me didn't do anything, right? So I'm not good at this technical stuff. I didn't touch anything. I was like going to take the whiteboard, that's it. So when you take the financial system of a country, you have the businesses, right? You have the banks, businesses. Here you have you and me, right? And here the government plays a crucial role. Government. So today I'm going to discuss, initially, that's where I think I need to start. Government, what are the types of receipts and what are the types of payments a government might have? So in terms of the government, the main source of income for the government is what? Taxes, which is being charged from you and me. Then apart from that, government may have some income from profitable state industries, charges made to consumers or state provided services. Majorly it comes through taxation. Main sources of taxation. Now when it comes to the government revenue, sorry, I might have touched this. No. Okay. So when it comes to the government, government has state-owned enterprises. Have you heard of state-owned enterprises? So using state-owned enterprises, government, it's like government doing business. So they earn some sort of an income from the government-owned enterprises. One thing. Secondly, the government might have investments made abroad. Those are known as sovereign investments. We did some stupid thing like that, like when the Greece was falling, we went and invested in Greece sovereign bonds. That kind of a helpful nation we are, right? So entire Greece was falling and going into bankruptcy. Our central bank went and invested in Greece bonds. Imagine, right? That kind of a helpful nation we are. So government might invest, and from the bonds, they will be like having some sort of an income. Apart from that, mainly through taxation, taxing you and me, individuals, and then basically taxing all the industries or companies of the country which makes profits, right? So that's how the governments raise receipts. So in the taxation part, you have indirect taxes, direct taxes, whatever, right? Payments. What are the payments governments need to make? So governments in the short term may make day-to-day costs such as wages and salaries. The government servants, they need to pay salaries, right? For defense, healthcare, all the ministries, everywhere they need to pay salaries. So in the medium and the longer term, governments need to pay for major investment such as school and hospital buildings. So just like a business, this government also might experience this mismatch. They earn tax revenues from this end, but they need to make now. Imagine the tax payments, everybody decides to pay tax payments in December every year. But when it comes to the payments, government salaries to the government servants needs to be paid every month. So there's a mismatch. So as a result, just like a business, they also needs to build up a synchronization mechanism. How can you match? So if a business doesn't have money, that's okay. The business can call the bank, ask for a bank overdraft, ask for a leasing facility, ask for a term loan. That you can do. But think, if the government doesn't have money, what can they do? Whom can they call? What can they do? What? We can ask other countries. Yes, one option. Or else, here see, credit and the savings needs of the governments in this respect are often met by the central bank. Have you heard of central bank? You can just peep out and see central bank is right there. Right? Central bank. Now, the business can go to the banks, but the governments, they go to the central bank asking for money. One of whose functions is to act as the banker to the government. Right? Banker to the government and to manage the government's finances. Since it is possible for governments to be net savers or net borrowers over very long periods of time, they may need the services of financial intermediaries over that period. So when you say financial intermediation or financial intermediaries, not only the businesses, but also the governments need this financial intermediation. Why? because there can be surpluses and deficits. There can be mismatches. That's the basic reason. So how do they do that? Everything we'll be discussing today. How do they fund everything? Governments also have the option, although it is a controversial one, of increasing taxation revenues to help fund higher levels of government expenditure. That being Sri Lankan, I should not be explained. Right? So anywhere on the earth, guys, if somebody is teaching about taxation, what's the best country you can give examples about? I mean, don't laugh. Be proud, right? Anywhere on earth, if somebody is teaching taxation, we have every bit of examples which can be taken from our own island nation, right? So be proud about it. How that happens? Raising taxes. I told you, like innocent Japanese government, like manufacturing a car for like 2 million rupees. Raw materials, labor, electricity, everything for the Japanese government. Profit margin, let's say 500,000. Sri Lankan government doing nothing. Doing nothing. What's the value they are taking? Taxes 23 million. Ultimately, the vehicle is 25 million. We are paying, and the Sri Lankan government doing nothing, earning money. That's business. So, actually speaking, guys, for students in Sri Lanka, so business is it's coming in their blood, right? Business is like there's nothing for us to teach business. Business is coming, right? We are selling, right? All the harbors and everything we are selling. Whatever the important lands and landmarks we are having, we are selling. So that's business. So business deep rooted in Sri Lankan people, right? And taxation, rest of the story I'll discuss later, right? So quickly we'll go to question number 2 and 3 before I explain this. So I'll be explaining about the monetary policy, how the central bank is helping the governments to fund everything. Lots of discussion today. Quickly come up with the answers for question number 2 and 3. Take 1 minute for both. So ABC chocolate manufacturers a range of different chocolate novelties for sale in major supermarkets. It has seasonal trade and finds that period before Christmas difficult from a cash management point of view, as it has to pay out money for wages and for ingredients before the holiday period, but often has to wait until the new year before receiving payment from major customers. Which of the following would be a suitable way of managing this cash flow problem? Good. Now think. You are working for a chocolate manufacturer, right? So it has a seasonal trade and finds that the period before the Christmas difficult from a cash management point of view. Now you are somewhere in September. Season is Christmas. Assumed to be like a lot of people consuming chocolates in the Christmas period, right? So just before the Christmas, you are having a cash management problem. You don't have enough cash. It is a surplus or a deficit? Surplus or a deficit? Deficit. So what are the options you have? They are asking which one of the following would be the suitable way of managing this cash flow problem? Yes. What can you do? Imagine you are the top management personnel in the company. So you can turn back the tute and see what are the options we had. If we are a business, if we are having a deficit of funding, what can we do? Right? One option is to go for an overdraft. One option is to go for a bank short-term loan. One option is to delay the trade payables. Right? One option is to ask from a friend company. Can happen. Right? So you have 4 options. What is the way most suitable? What do you think? Those who say A is the answer? Issuing new equity shares. B is the answer. C is the answer. D is the answer. Right. So there's nothing much to think about. Overdraft is the answer, right? Because like you can just go to the bank and ask the bank manager, why can't you like arrange an overdraft? Because of the temporary nature. Because of the temporary nature. Imagine like I'm in November, I need some cash in December. Am I going for a mortgage? Am I going for a share issue? No, definitely not. So these two, this is long term. Mortgage is a long term one. Leasing, I can say it's a medium term one. So answer would be overdraft. Right? Next one. In the recent years, FGH, a high-end furniture retailer, has appeared to favor mezzanine finance. When you say mezzanine finance is both debt and equity. Alternative forms of finance. What is meant by the term mezzanine finance? That's by definition, I think D. Okay, right. Now we are going for an important area. Financial products. Thanks, Tarini. Yes, correct. Financial products, right? So now you know that there's a deficit or a surplus, and accordingly you have to select whatever the product, financial product. There are lots of financial products you can select. I told you several like mortgages, overdrafts, leasing arrangements, lot of stuff. And you are depositing fixed deposits, call deposits, whatever. So when you are selecting, there are several stuff which you need to consider when you are selecting the specific financial product to match your financial need. First one is yield, returned on, earned, or the cost. For an example, investing in certificates of deposits typically gives a lower return than investing in equities. So, if you are selecting a financial product, one major factor you will be looking at is the return. There's nothing to explain it. Imagine you become a management accountant and your first month salary is 350,000 rupees. You get 350,000. So being so really into finance, you think of like investing this so that I can earn more return. I know typically you will like spend like you'll have drink, you will have some clothes or whatever. True, but imagine you are more thoughtful and you are investing. So you go to a bank agrees now if you can place a fixed deposit, I can give you 8%. You can go and invest that in the share market. End of the story. Then what you can do else? So there's a friend who is in need, like he needs to purchase something. You say like, okay, I have some money, I'll give you, but that's okay. Since you are a friend, just pay me 20% more. Since you are a friend, like I can help you because like you need money, now when I'm putting that in the bank, I earn like 8% of the fixed deposit, right? So for the friend, since he's a friend, you can like give it for like 20%, right? I'll give you money, but give it 20% back. So yield or the return matters. Clear? Then risk. What about the risk? So if you go and place the fixed deposit in the bank, right? Even though you get the 8%, you know that the particular name of the bank is right, commercial bank. This branch is here. So branch can't move. Anyway, my money is inside. So I have no risk. I can sleep tight. Why? Anyway, my money is inside this particular branch, this bank, I know for a fact. But when you give it to a friend, it's true that you are getting 20%, but when you give it to a friend, what happened? Friend can elope. Simply, right? Friend can migrate the next day. Friend can, I think friend can do a lot of things. So, how can I list it out? Anyway, you will be not getting the money. So risk. Risk is a factor. Firstly, return. Secondly, risk is a factor. Right? So the main determinant of cost or yield is risk. For an example, if a company wishes to raise funds by, so that is raising funds, I'm using my own example. Amounts involved or the divisibility. For an example, the price of an Amazon share was this, an individual investor buys. Now it's like this. You are having a lot of money, so you decide to invest in the share market. Right? You know what share market is? Next to that. You have the money market, then you have the share market. No, that's not the case. That's not physical something. Right? What's share market? Share market? Yeah, stock market. It's downstairs, right? When you go after the class, you can see share market is downstairs. CSE, Colombo Stock Exchange. So let's say a lot of companies in the share market, lot of companies, let's take all the banks, all the huge companies, will have shares listed in that like this. This is how it happens. Company A, company B, company C. One share is 10 rupees, one share is 15 rupees, one share is 18 rupees. Divisibility is if you need to invest, if you have 100,000, you can invest in this. Also, you can invest in this. But if you invest in this, exact value can you get? You can't invest in decimal points shares, right? I'm investing in 28.8 shares. No, that you can't do. These are units, right? So divisibility is a factor deciding how the investment is made. Divisibility of the amounts involved. Then the time period the funds are required or available. So you get some funds. Imagine the same on 350,000 you earn from your first salary, right? So you go and invest that. So you need a mobile phone when you go into the new job, right? It's the first salary. So you need to dress well, branded clothes and stuff, mobile phones, and a lot of requirements. For girls, it's like worse. First salary is 350,000. The requirement will be around 3.5 million, right? 5 days of going to work, 5 saris, 5 handbags, everything in the same color codes and everything. You guys like that's okay for us, right? So when that happens, there's a requirement for you to have that cash. Imagine the season is coming, you are planning to like purchase 10 saris. So that you need this 350,000 rupees anyway. But what you do, our lecturer told that investments needs to be made, right? So you should earn some return from this. You go and invest it for 2-year fixed deposit. Now you need to purchase the saris next month. You go and invest this fixed deposit for 2 years. So when you go and purchase the saris and ask for payment, the bank will say, you don't, damn idiot, you don't know what fixed deposit is. Fixed. The amount you place is fixed, come back in 2 years. That happens. So if you need the money in 2 months or 1 month, the particular investment you should be making is for that period. So if you need money in 2 months, you should make the fixed deposit for 2 months. You should match. That's for an example. Now, if you are thinking of like purchasing a vehicle. You have 5 million rupees in hand. You need to purchase a vehicle next month. But thinking of getting the return, you are investing that in a 1-year fixed deposit. Pointless. So factors, risk or the yield, return, then amounts involved, divisibility, time period, liquidity. Liquidity means liquidity. Yes. So if you are like investing, you should look for liquidity as well. So if you have money, you don't have anything to do with that money, right? You have that much money, you are so rich, like, right? You have a lot of money, you don't know anything to do. You play, and when you are sneezing, like you take 5,000 notes, like throw away. I don't want this. That much money, if so you are investing, that's okay because you don't want liquidity. But typical people like us, we don't know what the need would be. So if I have 5 million rupees and if I need to pay for my higher studies, MBA, whatever, can I like go and invest that in a housing loan, or I'm going and purchasing a house, new house from Mondragal? Right? I'm thinking like when I'm like feel bored, if I'm feeling bored, like I'll go into Mondragala and I'll go to the jungle and wait and see. So I'm having a property in Mondragala for 5 million. Imagine, right? So is that liquid? So imagine I'm purchasing a property from Mondragala so that I can relax and chill a bit. But the next day, I get a call from my university, you need to make the payment for your higher studies. So can I sell that property at Mondragala easily? Can, but to the animals. Right? So likewise, it's not liquid. You get my word, right? It's not liquid. So if you are making, so if you just put that in the savings account, that's okay. Whenever you need, you can go into the bank and withdraw. Give my money back. So liquidity is also a factor when you are like investing. Then transaction costs, like transaction costs for mortgages and likewise. Okay. So when you are like deciding on whatever the financial product to deal with, what are the factors? Repeat. What are the factors to look at if you are like selecting a financial product for whatever the financial requirement? Firstly, yield. Secondly, risk. Third, that's it. Loud sound, yield, somewhat slower, risk. Third factor, amount involved. Fourthly, time period. Then liquidity and also the transaction costs, right? Then, okay, capital and money markets. I just discussed this, right? Capital and money market. The basic difference is what? Money market is for? Money market is, do you think like just like the fish market and the fruit market, you have money place? Is it? So we can go and purchase now. Give me 10 notes of 5,000. Okay. It's not the case, right? So money market is where you trade money, true, where money is readily available, true, but not physically, right? Money market is for the requirements below 1 year. Below 1 year, whatever the requirements is fulfilled using money markets. So capital markets can be debt or equity finance more than 1 year. That's the basic difference. Then now we are going for an important this thing. Types of financial products. Now we studied about the financial system, financial markets, financial intermediaries, and selection of financial products. Then we need to understand what are the financial products. Firstly, ordinary shares. So as to what you know, what are ordinary shares? Ordinary shares. Yes. So did I explain about investing in the ordinary shares one day using an example? Did I? No, I didn't. Okay. I didn't discuss anything for these 4 months, no? Nothing. Even though I ask anything, nothing discussed. No, I can't remember. That's okay, that's okay. Right? Ordinary shares. So this is what? So these financial products and everything, take into your head, right? This is really important, and that's it. And then go home. Section 3D. Liquidity. Yes. So liquidity factor is Tarini. When you are like going and investing in somewhere, you should be able to convert that easily into cash. So what my example said was, if I'm having excess cash, but I need that cash back in 2 months. But if I go and invest that in some further property or some property purchase in a very rural area, right? So I can't make it into cash immediately. I'll have to locate a buyer. I'll have to advertise. Then it's not liquid. So that is what liquid means. Ordinary shares, right? So when a company is formed, This is my company. What was I was selling last week? Cupcakes. If you couldn't remember what my business was, right? Right. So cupcakes. So now I have expanded my cupcakes business. I'm a really good businessman. I need more money. I need more money, finance. Right? So one option I can go for is equity. Right? So anyway, funding, what I can do is debt or equity. Right? If I go for equity, what I can do, I can say my requirement is 10 million rupees. I need 10 million rupees immediately. Right? So what I can do is, I can say, I can call every bugger around the area and say, look, I'm having a share issue, right? So why don't you take shares in my business, my cupcake business? So I'll give you one share, 1 rupee. One share, 1 rupee. How many shares do I need to raise? 10 million shares. 10 million shares. So imagine I'm calling some of my rich students which I have taught and saying, look, in my cupcake business, poor me. So like, why don't you invest in my, right? So my students are really confident about my management capabilities, right? And then coming and investing. One say, look, sir, I'll give you 3 million, that's okay. Right? The other person, 2 million. And I have a really, really rich student of mine and investing 5 million. That's okay. And I'll also give you a premium, 1 million, you keep it. I don't care. Transaction costs, nothing. So what's the stake in that person in my business? 50%, right? Percentage wise. So by investing like this person owns 50%. So ordinary shares means the shares I'm issuing like this for the first time. By the formation of a business, if I'm issuing like my shares like this, these are ordinary shares. Okay, so they are the owners of the business. They have the voting rights. So I'm having a director board meeting every month, right? So the directors, whatever the people who is assigned now, who are directors? Now these people are shareholders now. Agreed. Whoever the person coming and investing becomes a what? Shareholder. Then who are directors? These shareholders can appoint somebody. These people, now I can't look into this business. So you just go and manage. He or she can say, like, I'm having one director in your director board. Imagine the director board is 5. Director board is 5. Poor and innocent me here. Another 4 directors, right? So this person might say, I'll give you a director for my stake. To manage my 50%, I'll give you a director. That's a director. So you have the director board. Through director board, only the management of the company happens. Clear? So these are ordinary shares being issued. So in this director board, whatever the decisions being taken, these people have the voting rights, which is on behalf of these shareholders, whatever the people appointed as directors, they can raise the hand and vote. Understood? Those are ordinary shares. Apart from this, I need some other set of cash as well. I need some 5 million again. Again, I'm going for a share issue, which is not ordinary shares. I call it preference shares. Right? So in ordinary shares, what happens is, now at the end of the day, I'm having this 10 million rupees. I have made a really huge expansion and I have made a profit. If I have made a profit of, let's take 20 million rupees, is my profit, right? 20 million is my profit. Now, what can I do with my profit? Don't ask silly questions. So 20 million, what can you do? You go whatever you want, have enjoy and have fun. That's it. Isn't it? No, if you are having profit of 20 million, what can you do in a business? No. before that. True, what you say is true. Now, if you have 20 million, he's saying like we can expand, yes. But before expanding for these people, do you think that because there's some my students in the class, they will say, okay, sir, I don't want dividends. You just build up, you just become a millionaire. That's okay. That's enough for me. Will my students say like this? Not on this planet, right? Not on this planet, somewhere else. So by investing this much, don't they need a return? Don't they need a return? What's the return then? Dividends. So from whatever the profits I get, I should pay dividends as returns proportionately to these people. So the beauty is, remember, when you get a profit like this at the end of the day, the director board might decide whether we should go with dividends or not. Just for the sake of saying that I had 20 million rupees profit, I don't want to distribute everything as dividends. That's not said anywhere. The director board might decide, considering the economic environment and everything, we will like keep 15 million with us and we will distribute 5 million only as dividends. Okay. So that 15 million is known as what in our financial statements? What? Retained earnings. Earnings which is retained, that 15 million becomes my retained earnings in the business. That is being recorded under the equity in the balance sheet and also in the statement of changes in equity. So I have 5 million to distribute. That's my decision from the director board. That is being distributed as dividends proportionately to these people. Okay. Even they can say entire 20 million, we are not giving dividends this time. They can decide. So ordinary shareholders, sometimes being the owners, might not receive a single dividend. Sometimes, if the director board decides the company needs to expand more, so we are not going for a dividend issue. Can happen. But if you go and invest in this kind of shares, let's say that is known as preference shares. What? Preference. Preference shares, if you go and invest, the company is bounded to pay a fixed amount of dividend. Whatever the company's performance is, the company assures for every share, I will pay 5 cents as dividends. That's how you pay dividends. Huh? Dividends are not coming in 100, 200, 300 rupees for a share. Cents. Okay. So they might have a preference shares might have a fixed what? Guys, are you sleeping? What is this number? Guys at back. 3? Oh, you're not sleeping. I'm relieved, right? Listen to me, sir. So, preference shares, you are paying a fixed dividend. So, don't you think now you have two options, no, debt and equity? The basic difference is for debt, you have to pay the return interest. Equity, you have to pay the return equity. What's the return paying? Dividends. In the shares, in the ordinary shares, you are not paying a fixed dividend. So if you are paying a fixed dividend for the preference shares, even though it is equity, can't I say preference shares is quite equivalent to debt financing? Think. Did you get it? You have debt financing and equity financing. For debt financing, you pay interest. No, so you go to a bank and ask for a loan. Anyway, every month, whatever happens, you have to pay interest. Clear? So can you go to the bank and say, oh, I can't this month my grandma got really sick and my grandpa is like, it's a mess in my home. I can't pay interest this month. Will the bank accept? Banks say, oh, that's okay. Yeah, we do understand, right? Okay, you don't want to pay this month, pay next time. Will the bank say that? No, which is interest is fixed. No matter what happens, you will have to pay. So when you take equity, you have two parts. I feel like speaking in the Dansala or something, like saying that Bodu Beti Gunagi, just like that, no? So equity you have preference and ordinary shares. For ordinary shares, there's nothing called fixed return. Nothing called fixed return. Why? Directors might decide that I will not be paying the return. But preference, fixed return is there. So can't I say preference shares is behaving like equivalent to debt financing? That's an important point. Okay. So preference shares behaves quite similar to debt financing. Understood? Now ordinary shares and preference shares, this is structure, you remember everything, right? So if you, for further clarification, if you need, draw whatever I draw on your tube. Right? So some later day you will be able to understand. Ownership of the companies is conveyed via ordinary shares. Important. Ownership conveyed by ordinary shares. Ordinary shareholders also have the voting rights. Shares have a nominal or a par value, which is usually different from the market value for traded shares. Companies often raise funds through this. So, what do you mean by this? Nominal, par value, market value. Right? Nominal, par value, and the market value. Now, in my example, what's my nominal value of a share? Nominal value or the par value? 1 rupee. But because of my cupcake business's performance, sometimes in the market, I can sell it for 5 rupees, one share. So that is my market value. So the single share, there can be nominal value or par value, and the market value can be really different from that. That is where the share premium comes. So imagine my nominal value. Take this into head, right? My nominal value is one share is $1. Sorry, 1 rupee. I'm living in Sri Lanka. Wait. Okay. One share is 1 rupee. But in the market, now many of my students are really into my cupcakes. So see, our lecturer is like having cupcakes, that tasty. I don't know who prepares this. Right? So everybody is into my cupcakes. As a result of that, every student of mine needs to invest in my business also. Right? Go to it. Okay. Invest in my shares. Right? So what happens? There's a really high, again the word demand. Share markets also works on the fact demand and supply. Right? So there's a very high demand for my share. So what's the relationship between demand and the price? Demand and the price. If demand increases, price, does it happen in shares? No. So if the demand is really high, if the demand is really high for my shares, what will happen? Price changes, not prices goes down, right? So demand and supply, I explained you in that market, it happens due to the interaction of the demand and supply, market forces, free market economy. There's nothing like that in the share market. Share market, there's a stock exchange, there's a regulator. So as a result, many people needs to buy my shares, buy my company shares. So what happens? Although the nominal value of my share is 1 rupee per one share, people might say, like this sweet student of mine, right? He will say, sir, I'll like purchase this for 5 rupees per share. Those are the students, right? So he will purchase it at 5 rupees per one share. Right? So if that person purchases 1 million shares at 5 rupees, what's my share capital? What's my share capital? What's the share capital I raised? Those who say 1 million? Those who say 5 million? No. Nothing, you say. Raised nothing. Listen. Nominal value of the par value of my shares is 1. 1 rupee, 1 share. But somebody is purchasing 1 million shares of mine, giving me 5 million rupees. So originally, if purchasing 1 million shares, the share capital I should raise is 1 million. Why? Nominal value is 1 rupee. But what I'm getting is 5 million rupees. So what's the balance? Use your calculators and calculate, students. 5 minus 1. You have calculators in the phone also? Right? So the 1 million I raise is my share capital. The excess I raise, excess amount of 4 million, right? Excess amount of 4 million, that is what you call share premium. Understood? What? What did you understand? Share capital is 1 million. Share premium is what I get due to the difference in the nominal value and the market value. Right? How do I get a share premium? Because of the difference, right? Because of the difference of the nominal value and the market value. If the nominal value and the market value both is 1 rupee, then I'm raising only the share capital, no share premium. But because the nominal value is quite different from the market value, I'm raising a share premium as well. That is what share premium is. Understood? So don't you feel like we should note it down in your tutes itself? Don't you feel? So then write it down, right? Share premium, what share premium? Use these examples, right? So you need to understand what share premium and share capital is. In whatever the way you need, you may note this down. Okay? Take the same one example and draw the diagrams and show. You can do anything on your tute. It's yours. Okay, so you may note down what share capital and share premium is. So when it comes to the characteristics, shares return, potentially very high returns if the company is profitable. You get very high returns if the company is profitable. If the company is not making a profit, you won't get any. Returns will be in the form of dividends. See, returns will be in the form of dividends and increase in share prices. That I don't want to explain because in the first session itself I told you, right? So increasing returns to the shareholders happens in two ways, dividends and also the capital price increase. Right. Then risk. Shares carry high risk. If company profits fall, then there's a danger of zero or low dividends combined with the fall in the share value. Furthermore, in a worst case scenario, the company is liquidated, shareholders only get paid if there is any money left after setting all the clips. So it's like this. Now see, when it comes to my business, if I'm analyzing my finance providers to my business, cupcake business, I have my bank gave me this much of an amount, right? I have my own capital. I have my own capital which I have invested. Clear? I have preference shareholders, right? So we'll not take capital here because ordinary shareholders I will take. My capital is inside that, no? Thanks. Right? So bank I have preference shareholders, I have ordinary shareholders, where I am also a one. I am also a ordinary shareholder. Right? So imagine, even though I'm good at teaching theoretically, think practically I'm not good at managing my cupcake business. This has resulted in making continuous losses and getting bankrupt. And getting bankrupt. Right? Don't feel sad. Right? I'm getting bankrupt. So I have the dues to be paid. Is it? So I have taken a loan from the bank. I have taken some money from the shareholders. So shareholders means, have I taken money or what? So I have shareholders in my business means what? They have given me money. In return, I have given them shares. All right. So if I go bankrupt, I need to pay each of these persons. I need to pay, right? So I can't be like Sakvit Rana Singh and run. Right? I'm not paying a single cent, I run. Take all the money and go to some other country and live. That you can't. You have to pay. So when you're paying, what's the order you will have to follow? What's the order? So these ordinary shareholders are my own students. So I just need to pay them first. Is it? Or else then I'll have to go to the bank. The bank people are always coming into my home place and shouting, pay, you idiot, if you take loans, pay. So I just need to pay. Or the preference shareholders, what's the order? So if it is 1, 2, 3, what can I do? Whom should I pay first? I'll make it ABC because if not, A, B, C. Whose debt I should pay first? To whom? So you mean I'm valuing bank rather than my own students? That's bad, no? Right? You have to pay whatever happens the banks first. If not, they will come and squeeze you and take whatever available from you. Right? So pay the bank first, number one. From these two people, preference and ordinary shareholders. Why do you say so? Right. Correct. Right. So preference shareholders next. Preference shareholder. That's why they are called preference shares. In terms of liquidity, in terms of eventuality, in terms of default, they are being given the preference than the ordinary shareholders. That's why they are called preference shareholders, right? So ultimately, after paying everything, if something, imagine 500 rupees remain, right? I have 500 rupees and my clothes. That's it. Right? So clothes obviously I can't give. This 500 I can give proportionately to the ordinary shareholder. Which is after paying every counterparty, whatever remains, if remained can be proportionately given. Don't give the clothes, right? Only the money. Okay? So that is ordinary shareholders. So what do you think about the risk here? If you have factors to think of now, I said, in terms of risk, which one is more risky? Preference shareholders, ordinary shareholders. Like if you are an investor, if you go and invest in a company, right? Which is more risky? To invest in ordinary shares or to invest in preference shares? Ordinary shares. The risk is unlimited. Risk is unlimited. Because why? You may lose everything you invested. You may lose everything you invested. Okay? Preference shareholders at least get something. If they get 500, they might get 1000. After paying the banks, banks can't help. Got it now? Right. Why all of a sudden silence came on? That's so weird. So if companies profits fall, then there's a danger of zero. Oh, this is what I said. Liquidated, then the shareholders only get paid if there is any money left after settling other claims, right? Any money left after settling other claims. In such situations, the shareholders usually get nothing. Okay? Then, yeah, 30. Yes. There's one more message. Ordinary is more risky than preference. Obviously, yes. Time scales. Ordinary shares are a permanent source of funding for the company unless they engage in a share buyback. So equity is considered to be long term. Did you get what they said? So if somebody comes and give you money, if they invest in ordinary shares, do I need to pay that back? Yes or no? Do I need to pay that? Now, if you get a bank loan, do I have to pay that? Definitely. If not, they will come and you know what they will do, right? Squeeze and get the fluid out, pay, right? So equity, if you go and invest in equity, there's nothing like that. That's a permanent source of funding. So just in case if the management decides to go for a management buyout, we'll be learning about it. If not, you don't have to pay. That's permanent funding. Because for that permanent funding, we have given the ownership. Clear? So that's it. And liquidity, for unquoted companies, it's very difficult to sell the shares. But for quoted companies, the shares are highly liquid. So investors can cash at any point. What do you mean by that? Tell me, ordinary shares, liquid or not? Ordinary shares, liquid or not? Fluid. Not liquid, fluid. Then liquid or not ordinary shares? What do you think? Liquid subjected to being quoted or unquoted companies. That's another story. So what do you mean by quoted and unquoted? So my business, my cupcake business. Now all these things, remember guys, these are the fundamental building blocks of finance, right? Whatever the finance qualifications you may do, no matter what, you might sometimes become a PhD holder in finance one day. I'll be dead. You'll become, right? Even still, you need all this. So take into head, note down whatever, understand, right? So in my business, again in my cupcake business, I'm raising shares, right? So I'm issuing shares and I'm raising finance. But from a very little crowd. I can start my cupcake business and come into this class. I can say, I need investors only from this class. I don't care about the F1 buddies. I need BA1 students to invest in my cupcake business. Easily convinced, right? So as a result, you all come and invest. But when it comes to big companies, they can give that option to the general public as a whole. Every Sri Lankan living in the country can go and invest in the Colombo Stock Exchange in whatever the companies you have. But if I form a cupcake business and we people get together and make a business, can other people from other areas can come and invest? No, which is unquoted. I'm not quoting it. So if I am to have more access to funding, so my business is small. So when the time span goes, right? When the time span goes, I'm expanding it into other areas, other countries, and likewise, I need more and more funding. I need access to more and more funding. So what I will do, I will select a stock exchange. Again, living in the island nation, you have no option. We have only one stock exchange, that is Colombo Stock Exchange. You can't go and invest in New York Stock Exchange. London Stock Exchange, you can't. You have to invest in Colombo Stock Exchange, right? So what I can do, this is Colombo Stock Exchange, CSE. I'm going and listing my business. Listing. I'm going and listing. So I become a quoted company. Quoted. So what happens after the listing process? I have my company, I have shares, right? I have shares which is being traded in the stock market. So every day the share market price fluctuates. Today my share is 1 rupee, tomorrow 2 rupees, again 3 rupees, again 1 rupee, likewise. So by listing, what happens is anybody living in the country can come and invest in my business. Not only the students in my class, wider access, right? Some people from Jaffna, some people from Betikalo, some people from Kataragama, any people can come and invest in. They don't want to actually come. They can do it online, right? So come and invest in my shares. So access to the capital increased or decreased? From the company's perspective, increased or decreased? Increased. So in the previous case, I only have you people. I'll have to beg. Now you come and invest, will you? Like, you can beg. But if I go and list, what happens? Entire Sri Lanka can come and invest. Listing. So in listing, if I have done listing, what about my shares, the liquidity? So if I have not listed, which is if I am unquoted, only you people are the people who is investing in my share, so not liquid. If you have invested, if one person has invested in my shares and you need to get rid of that, you need to find one person. Now look here, that Bugger's Cupcake Company, I have shares, I don't care, you just purchase it. I'm giving it for free. You have to say. But here if you have listed, today one person will come, today the other person will go, some will come, go, come. Likewise, anything can happen. So if you need to sell, since it is the share market, you can just sell it immediately and leave. Liquidity is high or less? High or less? High. If I have listed, liquidity for the shares, high. Clear enough? Everybody understood? Right. You may note down whatever required. Huh? So it's not a A-level class, I have told you. Whatever I say, if you feel it's required, you may note down. If not, don't. Then bonds. So even foreigners can invest via CSE, yes. True. Don't repeat the same joke today. Right. Bonds. Right. Bonds. Just as the total equity of a company is split into shares, loans may be broken down into smaller units. One bond may have a nominal or a par value of $100. Different varieties include debentures and long stock and may be issued by companies, local authorities, and governmental organizations. Bonds will normally have a nominal value, a coupon rate, and redemption terms, right? Bonds. Now, I'll teach you about treasury bills and treasury bonds, right? Treasury bills and treasury bonds, will be needing it anyway. What will happen to know about the bond market? Now, when you go and invest in a fixed deposit, what happens? You go and invest, let's imagine you go and invest 100,000 rupees in the bank, right? So when you go and invest 100,000, the bank agrees that I will pay you 10% interest. What's the interest earned? Now, when the bank say it's 10%, for which period? 1 week, 1 month, 1 year. Agreed. Yeah. So, but normally, generally, banks quote rates for a year, right? When you say like, now you might confuse like this. You go and invest in a 3 months fixed deposit, right? Banks might say, I'll give you 8%. That 8%, do you think that's for 3 months? No. That 8%, it for 1 year. That rate is for 1 year. So for 3 months, you will have to divide it by 4 and take. Clear? So 10% interest rate, bank agrees. What's the interest earned for a year? Use your calculators. No problem with that. 100,000. You mean this K is 3 zeros. 100,000 into 10%. 10,000 interest earned. 10,000 interest earned for a year. Quite simple. You earn the interest. You can calculate the future value of the particular fixed deposit is equal to present value 1 plus Rn. You know this equation, right? You know this future value equation? Don't say no. You learned that in the government school in grade 5. Right? Just after scholarship, they teach this. Isn't it? Future value? Right, whatever. Now learn. So fixed deposit is like that. So you have another instrument that is treasury bill. Right? Treasury bill, this is what happens. Today, imagine it's January 1st. I'm going into the bank and I'm telling I need to invest in a treasury bill for 3 months. So in the fixed deposit, I invested the 100,000 and I got the 10,000 after 1 year. Right? After the period, I got the interest. But in the treasury bill, what happens is, treasury bill, I'm going and purchasing a treasury bill of 100,000. Right? For 3 months. For 3 months, I'm purchasing a treasury bill. For that, today I will pay 95,000. So what's the change in the mechanism? Do I get an interest here? Is there any interest in the treasury bills? Is there any interest? You have two options, yes or no, right? So you say yes, you say no. Treasury bills interest, right? What happens is there's a small change in the mechanism. I'm going into the bank and I'm purchasing a treasury bill of 100,000, paying 95,000 today. So ultimately, after the 3 months period, I'm getting the face value of the treasury bill, which is 100,000. Since I have paid 95,000, I have made a return here. I have received a return, but that is not interest. Right? Treasury bills does not carry interest. Fixed deposit, quite straightforward. You go, invest the capital, and you get the interest portion at the end. Same own thing, but different mechanism. I'm going and purchasing a treasury bill of 100,000, paying little. So after waiting for the 3 months, I'm getting the face value of the bill. That is a treasury bill. Those who understood? Halfway. Like this, right? Treasury bill. So then, this is, remember treasury bills. When you take treasury bills, that is for a period of maximum 1 year. Maximum of 1 year treasury bill. TBL, right? If that goes beyond, that is known as treasury bond. That is the interesting part, right? Treasury bonds. So comparison of fixed deposits and the treasury bills, understood? No interest, just a matter of a discount. Face value received at the end of the tenor, you are paying less at the inception, right? So have your break and come. I'll explain you about treasury bonds, right? And the money market operation of the central bank. Because treasury bills and treasury bonds are issued by central bank. Okay, so we'll look into it. Quickly have your break and come. Some idiot is playing, so I'll have to inform Wisdom IT team to check on that. So you just go and come, right? Yeah. Yeah. Okay, we'll start, guys. So I was explaining about a treasury bill, how that works in comparison with a fixed deposit. So when it comes to a treasury bond, now I told you treasury bills is for a period less than 1 year, right? So treasury bonds can be issued for very lengthy time periods like 2 years, 5 years, like 10, 20, and even for 25 years, right? Treasury bonds can be issued for like periods 25 years. So if the same structure do work, just like for the treasury bills, how long will I have to wait if I invest in, imagine I'm investing for 25 years bond. I'm paying like, let's say it's like 10 million. Same on structure, I'm paying like 9.8 million, sorry, 9.5 million. I'll be waiting for 25 years to reach that, right? 25 years. You can get married and like have 2 kids. 25 years, right? Simply. So that won't work out. So the sole difference in between treasury bills and treasury bonds is that even though the same structure works out, you will be getting an annual interest as well. Every year, you will be getting an interest that is called coupon interest. So there's a particular rate that is coupon rate, and then you are getting annual interest that is coupon rate. So you don't have interest in treasury bills and treasury bonds. Sole difference is there's a discount structure, and also you are getting coupon interest on a monthly basis when it comes to treasury bonds. So it's okay for us to go and invest in a treasury bond, right? Because you don't have to wait this long. Anyway, you are getting a return on an annual basis also. Clear? So this treasury bills and treasury bonds, these are issued by the central bank, right? Central bank is there. Central bank issues treasury bills, T bills and T bonds. T means treasury, right? So this is less than 1 year. This is more than 1 year. Okay. Central bank issues. There are two another financial instruments which I'll explain at the same time, which is commercial papers and corporate debentures. Corporate bonds or corporate debentures. Now, the central bank can issue treasury bills and treasury bonds. Why do central bank issue all this? Why? What's the purpose? To match the government's funding requirements. So when the government is there and they are asking for money, they will tell central bank that we need money. Clear? So what will happen? They will issue treasury bills, or else they will issue treasury bonds. Issuing means now the central bank might say for this week I'll be issuing 100 billion worths of treasury bills. So what do all the banks and all the surplus parties and everybody is going and doing? what do? They go and purchase these treasury bills. So imagine every one of us is going and purchasing a treasury bill of 1 million. So purchasing a treasury bill of 1 million means what? I'm giving 1 million to the central bank and ultimately a violent nation's government, right? So more you go and invest in treasury bills, that's how it happens. So that's a must. I'll explain you why that's a must. Every country, people should go and invest. How come? If not, the government have money, right? Unless you print. Okay. So treasury bills and treasury bonds is to meet the funding requirements of the government issued by the central bank. You heard me right. Okay. Issued by central bank to meet the funding requirements of central bank. Sorry, government. Just like that, there are two another instruments. One is commercial papers. Commercial papers. Other one is corporate debentures or corporate bonds. Right? So, just like these two, just like treasury bills and treasury bonds, some blue chip companies, some huge companies have the authority or the permission to issue these two instruments to raise finance. Blue chip companies. So can to develop my cupcake business, can I issue corporate debentures? Why? It's a blue chip company. For me, not for the country. So huge companies, mostly banks, right? Mostly the banks and John Keels, like Browns, okay, Hemas, and likewise huge companies, they can raise finance using these two instruments. Commercial papers, common, quite equivalent to treasury bills, which is short term in nature. Imagine John Keels need 10 billion rupees to set up another cinema life in Batticalow. Right? So they will raise commercial papers. So they will ask people, we are issuing commercial papers. So why do these blue chip companies involved in this? What is the reason? Anybody who hasn't heard the word John Keels Holdings? Haven't heard. You have heard. How come? Right. Now heard. John Keels. Right? So only the blue chip companies can come to the front and say, look here, I need money. You just give me money. I'm giving my undertaking. I'll pay you back. So when we hear the term John Keels, my goodness, that's okay. They will pay. Commercial bank, yes, they will definitely pay. Right. So Sampath Bank and whatever the bank, not blood bank. Right. Commercial banks means commercial category banks. Under that, one bank is commercial bank, that blue color one, right? Commonly, all are commercial banks. So they may come to the front and say, like, give me money, I will give you the undertaking that I'll pay you back in 5 years. So if I go to the market, I'm like going to the downstairs WTC, I'm taking a mic and selling, I need money, I'll give you an undertaking, just give me 100,000 rupees each. People like throw every stuff at me and just like, so people don't have the market confidence. So when you say John Keels, you know for a fact that they will pay. When you say Haley's Holdings, you know for a fact they will pay. So as a result, these two instruments can be issued by only large blue chip companies. Right? Not the grocery man in your village. He can't issue debentures. So commercial papers pretty equivalent to treasury bills, which is short term in nature, corporate bonds, or the term debentures. Have you heard of the term debentures? All the banks who are doing debenture issues for the past 2 years, they can do. If they don't have money, they can issue corporate debentures. Issuing corporate debentures means what? They are raising finance. You got the word? Issuing all these, by issuing treasury bills and treasury bonds, What do the central bank do? Central bank is getting money. Money flow happens this way, right? So similarity between these two items, you need to remember only difference issued by central bank, issued by blue chip companies. Understood? Now you know 4 financial instruments. Clear? Anyone? Next part. Then about the bond market. Now it's about bonds. So, sorry. Correct return. Typically, bonds have low returns because they are a lower risk instrument. Now tell me why. Lower risk. When you say fixed deposits and treasury bills, which one is more riskier? Which one is more riskier? Treasury bills. Yes. Fixed deposits. Those who say fixed deposits is risky. Those who say treasury bills is risky. Right. In theory. Now, don't think about our country, right? In theory, now you are in UK, almost one step in UK because this is a UK qualification. In theory, treasury bills, so the treasury bonds is considered to be zero risk. Zero risk. Why? Backed by government. This is issued by the central bank, who is the big brother of all the banks. Fixed deposits are products. Fixed deposits are products issued by banks, small brothers of central bank. But this is the big brother, central bank. So if he is assuring that I will pay, do you need any other assurance? No. So as a result, these instruments normally considered to be zero risk. The reason is, just in case if some eventuality happens, central bank with the instruction of the government has the authority to print money. Print money. Money printing. Again, if you are Sri Lankan and if you don't know about money printing, jump from here. Right? All these economic terms, this zero risk treasury bills, bond restructuring. Now, what did we do? Like IMF, all this shit, what were they doing? All the treasury bonds issued by the central bank, we were a bankrupt country. We declared bankruptcy that we don't pay. So what did we do? The long-term bonds which we were issuing, which we had issued, I told you that our people, our big brothers went and invested in Greece also when they are going into bankruptcy. So we restructured the bonds. Right? Just Google and see what bond restructuring is. That's the case. So we were printing money, we were testing every economic concept over the past 10 years. Right? We are from that generation, right? Be proud. So to your kids, like after 10, 20 years, you can say, no, we lived in that era, right? We printed money, like we paid this much of taxes. We were like doing nothing. You can tell, be proud. Okay. So theoretically, if you go and invest in a treasury bill or a treasury bond, that is considered zero risk. Why? Even by printing money, your return is guaranteed. So commercial banks can't do that. No, they can't print money and give. No, there are enough of banks who went into bankruptcy, right? So one fine day in UK, I was not there. So they got a message that the entire bank is not paying out every money, every like pound. So like what happened if such kind of information is rumored all around the society, every person get panics and every person is going into the bank and asking for money. So bank is having a process, right? So they take money and they give loans. So at once if everybody comes and asks for the money, how can they give? So ends up in a bank run, right? Just Google it and see Northern Rock Bank, UK. So it ended up in a failure like that. There are enough and more bank failures. Silicon Valley Bank, Lehman Brothers, we'll be discussing about it. So zero risk, why, can be printed and given. We'll go quickly. What? Stint. Okay. So bonds are usually lower risk than the equity for the investor. For an example, bonds may be secured, used and collateral, and the interest rate is fixed. You can get high risk unsecured junk bonds, that's later. So in general, risk is really less in bonds and the return is also less. So you know that if the risk is high, return is high. So if the risk is less, return is high risk, high return, low risk, low return. Come on, girl. So time scales, the maturity is defined on the bond and varies from, so they can go up to 25 years, 25-year bonds, right? Some bonds are redeemable, will be repaid on the fixed date, and some are irredeemable, do not get repaid instead, interest is paid into perpetuity. Heard the word perpetual treasuries limited? No? Not Sri Lanka. Perpetual treasuries? I'll tell you the owner, Arjun Aloysius. Now you know. Perpetual treasuries, no? On guys. So all these stuff practical. Long-term bonds, 25-year bonds. No, now the government is claiming on a bond scam. So what did they do? Did somebody went into the central bank, took 10 billion rupees, packed into bags and took that money and went on a plane? Is that the case? No, that was something regarding to these bonds. Right? So there are some bonds which are irredeemable. I said now bonds are for 25 years. Sorry about it. So that can be for a period of 100 years, right? Until eternity. So there's no any maturity period. What happens is every year you are getting interest. Irredeemable bonds. Okay. Liquidity. If the bonds are unquoted, then the investor has no choice except to wait for redemption. However, if quoted, then they will be easier to liquidate. You know what quoted means. Just like equity shares being quoted in the stock market, bonds can be quoted in the bond market. Okay. So if it is unquoted, you will have to wait for somebody to purchase it. But if it is quoted, if today I need, I'm purchasing, I don't want, I'm selling it. Clear enough? Liquidity is high or less? High if it is quoted. So next part. Certificates of deposits, I'm not going to tell, that's almost equivalent to fixed deposit, right? CD states that the deposit has been made with a bank for a fixed period of time, at the end of which it will be repaid with interest known as coupon interest rate. So normally in the country for fixed deposit, we are not using coupon interest rate, that's just the interest. Coupon comes in the bond market. So return, very low returns, risk, safe. If you go and invest in a fixed deposit of 100,000 rupees in a bank, it's safe because you know for a fact that they will pay. Right? You know for a fact that they will pay rather than giving it to a friend, even at 20%. Time scales 3, 6, and maturities are common. Liquidity, yes. Even though you say it's a fixed deposit, you can go and uplift than fixed deposit, then come. Credit agreements. Credit agreement is an agreement where now all these are financial products I'm telling you, right? Treasury bills, treasury bonds, corporate debentures, commercial papers, fixed deposits, everything are financial products. We are in the financial system. You have financial markets, you have financial products, you have financial intermediaries. So learning about everything leads to learning about the financial system. Clear? So credit agreements is an arrangement where one party borrows or takes possession of something in return for future payment. For an example, credit cards and store hire purchase contracts. So anybody who is having credit cards? Congratulations. Right? Credit cards. So credit card is a arrangement given by the bank. Now, when you go and ask for a bank loan, the difference is, right? Checking my patience, right? So when you go and ask for a bank loan, you agree for a stipulated amount. 1 million rupees, stipulated period to be repaid over 5 years at an agreed rate. You giving me at 18%. But credit cards, there are something called credit, it's a credit agreement. Depending on my credit worthiness, I'll be assigned a credit limit. A credit limit is being assigned, let's say 200,000 rupees. So for whatever the reason, they are not asking the reason, I can go and use that, but I have a stipulated period for which I should pay. Payable on demand. The interest is really high. For a bank loan, it's 18%. For a credit card, it's 28%. Right? So just like that, credit agreements can also be a financial product. So to match our requirements. So up until we get the salary on the next month, we can use the credit card and do whatever the shit you need. You can go and play, can watch movies, can purchase any of the stuff. But remember, ultimately, you will have to pay. Right? Do whatever, pay. My advice, don't take credit cards. Right? Don't use. Right? So, return, usually high interest rates, very high. Many people has fallen into trouble using like credit cards, okay? Because you don't have the control over. You end up using, ladies, don't, if I can come up with a rule in the parliament in the country saying, don't give credit cards to the ladies or the women, I will do it. Right? But in terms of in the perspective of a bank, it's good. Right? In the perspective, now, I know for a fact that, right? Okay, so if some person now banks, in terms of banks would like to lend more to women. Why? What? High spending? No, I don't agree. Ladies don't spend. Really? No, I don't think. Now every bank is having women banking centers, no? So is the bank having male banking centers also? Have you seen a bank? Have you seen any bank? So it's male banking center. No. But every bank is having women banking centers. They are promoting women banking, women products. In my bank also. All the products, pink color. ATM card, pink color. Right? So another reason, right? That's the reason. They don't spend much. Sometimes, some ladies, I know how they spend, right? But they tend to pay more. They tend to pay more. Right? Like, so they are very economical, ladies. Just like mom in a family, right? So guys actually they do spend, they may drink, they might go anywhere they need, they might spend, but when it comes to the repayment, not that attractive. But the ladies go and purchase 10 saris at once, then likewise spend, but they are mindful of the repayment. They are really economical, right? They have the mind now. I purchase, but I should pay. But we people go to bank, credit card and the bank manager, you go to hell, I'll drink and sleep. Right? That's it. That's how it happens. So as a result, credit cards, high interest rates. That's why, right? You have seen practical. Women banking centers in every bank. So they are really economical and they tend to pay more. Repayment wise, they are okay. Right? I don't know, people say. Usually high interest rates, risk, credit card company faces the risk of default. Very high risk for the banks. Imagine if you give a loan, if you give a bank loan, you are keeping some kind of security. I told you, to get a personal loan of 500,000, you need grandma's birth certificate also. Right? So you need security. But the credit cards, no. No any purpose, no any reason. So when you give that to the people, when you give a credit card to that person, he can do anything using that, purchase anything, play online games, whatever. No control over. Highly risky. What if the person uses that, after using, throws it away and can't be found. Imagine I'm living in gold. I'm taking a 300,000 credit card, using it, throwing it away. I'm going and getting settled down in Anuradhapur. Bank won't find me. Can happen. So the risk to the bank, credit agreements, credit cards, extremely high. For the customer, for the person who is taking the credit card, what do you think about the flexibility? Yes, yes. Some are against FD, but that's not the general practice. Generally, credit cards are issued considering your credit worthiness. Go to a bank, go to some kind of banks, they might ask, okay, give you a NIC copy, give 3 salary receipts, give you employment confirmation or whatever, we can give 300,000. Salary is 25,000. Credit limit 300,000. Some banks do, right? So sometimes it's backed by time scales, usually intended to be short term, although some individuals can get into financial difficulties by running up large debts. Liquidity, debt cannot be resold by the lender, but the borrower may be able to repay early if funds perk. So actually speaking, guys, it's a good instrument, right? Credit cards, it's a good instrument, but you should be wise enough to use it. Not wife enough, wise. WISE, wise, right? So imagine shopping in the season, right? Every shopping like this textiles people will give discounts amounting to 25%, 30% likewise. So some wise people, if you are wise enough to use it, you can use the credit card and do the purchase. So if the amount of the purchase of your clothes is 100,000, like you buy 5 pieces, it's 100,000. You're so posh. So 100,000. So 25% discount means the cost is 75,000. So you can pay it using the credit card, but you need to settle it. But what our people do? They purchase clothes for this April using the credit card, take the discount. They say now we should purchase definitely. Why the discount is there on 25%? We go and purchase, but settle next April. So is there a point? Interest it as 28% currently. So that's why I'm teaching about every financial product. That's why. So you should be wise enough to use it. Use, settle. Okay. So credit cards intended to be short term. Okay. So then liquidity. Now the bank who has issued the credit card, they can't do anything because we have issued. But if you have money, you don't carry any interest cost, you can pay. So you do the purchase and then after a week you can settle it down. Clear? To be in the financial system also, you need to have some kind of financial knowledge. Isn't it? Right. Mortgages. What's a mortgage, guys? Mortgages? Anybody? A mortgage. A mortgage is a loan to finance the purchase of a property, usually with specified payment periods and interest rates. So the difference here is a mortgage is now when you go to the bank, now anyway, you have 2 funding options on this earth. What are the funding options? Basically, debt and equity. So being an individual, like I am earning a salary, so I can't issue shares on my behalf. So shares of mine from this area, I can't do that. No, I can't issue shares. So what I have to do is I'll have to go to a bank and take a loan. So if that is a short-term requirement and a small requirement, I might give some guarantors. I might ask some friends to sign on behalf of me. So if I don't pay, they will pay. That's the arrangement. I'll anyway don't pay. Right? So that they will end up paying. So that is guarantors. Right? Guarantors. So if that is a big purpose, if that is a capital purpose like purchase of a house, the value is high. Now, can you purchase a house using 1 million rupees? 10 million? Can single story it. 1 bedroom, 1 kitchen likewise. So at least you need 20 to 25 likewise. So will banks give these amounts without proper security? Will banks give? Definitely not. Banks won't give even 100,000 without proper security. So they might need security which is called mortgage. So mortgage means now I have this house which I am going to purchase. I'm poor, so I'm purchasing a single storied house, one bedroom, one kitchen, one everything. Right? Purchase. So what the bank will say, they will come up with the agreement saying, a legal agreement saying, this for this house you have the ownership, but I'm signing a legal agreement. If I do not pay the loan, bank has the right to go to the courts and acquire my property, sell my property off, settle the bank loan, and if remains, give something to me. That kind of a legal agreement, I'm calling it a mortgage. Property mortgage. So what happens here? I'm purchasing the house. I'm purchasing it. It's on my name. I'm getting a deed of transfer, I'm getting ownership, everything is mine. But I'm signing a legal document with the bank, authorizing the bank, saying what? If I don't pay, you can sell the property, settle whatever the loans you have, and give the rest to me. That kind of an arrangement is known as a mortgage. So lot of lawyers from that 10 lawyers from the bank, lot of transaction costs. It's a huge process, right? Bank will have to look for the proper survey plans and everything. That is a mortgage. Understood? So a mortgage is a loan to finance the purchase of a property, usually with specified payment periods and interest rates. Return. The interest cost is usually relatively low as the mortgage will be secured by the property. Now, think of a personal loan of 1 million rupees where you have not given a property or something like that, and a housing loan which you have taken for 25 years. Which one is less risky for the bank? For the bank. Which one is less risky to the bank? Housing loan. Why? For the housing loan, you have a property as a security. For the personal loan, do you have anything? No, if the person is not paying, we'll have to go around that person and ask, please pay, please pay. But for the housing loan, it's more secured. If the person is not paying, put on ICMAN, sold, settle the loan, give the rest to the person. So as a result, housing loan rates are a bit less than the personal loan rates. So all these interest rates are linked to the risk, you can see, right? So for the longer term, as you have a security, risk is less, interest charged less. Understood? So risk considered low risk, time scales longer term 10 to 35 years, mortgages can be resolved by the lender. Don't think about it. CDOs I'll be explaining later. So that's the arrangement by the bank. So CDOs, right? So if you take a housing loan or property, you will have to pay. If not, the bank will sell the property and settle. Bills of exchange. So by now, before going to bills of exchange, what are the financial products we discussed? Now you know a lot. Financial products. Can't hear. Ordinary shares, bonds, credit cards, treasury bills, treasury bonds, commercial papers, corporate debentures, lot of financial products, right? So then bills of exchange. A bill of exchange is usually issued by companies to finance trade and promises to pay a certain sum at the fixed future date to the other party. In many respects, it's very similar to post-dated checks. Now, it's like this, bills of exchange. I'll explain. So you do an international transaction, right? You're into international drug dealing, right? You are here, the Sri Lankan importer right? Somebody here in some other country, let's say China, right? China. So you are importing something. You are importing something. So here the Chinese man will send the goods. Will send the goods. In return for the goods, what do you need to do? You need to make the payment. But we don't actually pay, no, guys. We are Sri Lanka, right? Then and there, we don't pay, right? So, like, he will be sending the goods. What happens? I will say, look here, like, majority of your country's people are living with us, so we are friends. So, why can't you make any negotiation? So, I will not pay. So, can I, like, have 3 months for me to pay? I can ask. I'll, like, pay. Say, we are friends too. Most of your people are here in Colombo. So, Chinese people. So, what happens in this case? Goods, the Chinese man will send the goods and he will agree, right? Okay, you just have the goods, you sell your goods, get the profit, then pay at least then pay. So for that, in that instance, you should have a particular contract or agreement which is known as bills of exchange. It's a particular document. So I will sign a bill of exchange. The bill of exchange will be created, prepared by the Chinese seller and will be sent to me saying whatever now you agree like this, like this, like this, like this to give you property and everything. So I will sign it. I will sign the bill of exchange and say this agreement says I will send the goods and I will settle with 3 months. So originally, when you send the goods, you should make the payment. That's how the international trade happens. But rather than that, I'm coming up with an agreement. He will be sending me the agreement to sign and say, look here, I'll be making the payment after 3 months. That's good. So I'm selling off the goods, making the profits, then pay. Okay? If he agrees. So that those are known as bills of exchange. So as I stated above, there's usually no interest paid, but the return is the difference between the discounted amount, whatever. So there's no any interest to be paid, but there will be like slight changes, like some kind of an additional benefit to the seller likewise. So for an example, a bill bought for 4,900 is redeemable for 5,000 after 3 months. Can happen. Bill value is 4,900, you will have to pay 5,000. So 100 profit is made, whatever. Level of risk varies, time scales short. Now, Chinese person will not allow for you to pay in 3 years, short term. Actually, maximum of 1 year. So short term, 3 and 6 months maturities are the most common, can be sold on the money markets. What do you mean by that? How can you sell this? How can you sell this? Can you sell bills of exchange? Yes. Now, after signing these bills of exchange, I'll be sending this to the Chinese person. So, like he is having, okay, now it will take 3 months for him to pay. I will wait. Looking at it. So he can't wait looking at it. He also need money. He's also a businessman. So what he will do, he will take these bills of exchange to some other person. Imagine if the value is 1 million rupees, he will say in Chinese language, right? I don't know. In Chinese language, he will say likewise. And look here, you just keep these bills of exchange where I will be getting the money from this Sri Lankan idiot after 3 months. So you just give me 90% of the value to me so that I don't have to wait. You understood? Because of the reason that I can't make the payment, I signed a bill of exchange for 3 months. He agreed, Chinese person, right? So he is getting the bill of exchange to him. He also needs money. Although he agreed, he also needs money. So what he can do, he can go to some other person and say, keep this and give me 90% of the value. That's called bill discounting. Invoice discounting, bill discounting, factoring. We'll be discussing about everything. So what he will say, look here, this is 1 million worth. So give me 90% of the value today so that I can work on with my production. He can do that. So accordingly, how about the liquidity of the bill of exchanges? Is it liquid? Yes, it's liquid. Now those who understood bills of exchange mechanism, okay. Next part is a question, right? So now you know what are the components of the financial system, several financial markets, financial products, how to select financial products, everything. Question number 4 and onwards. Bill discounter, invoice discounter. Yes, 10%. Sometimes there are some arrangements like in factoring, 90% they will give immediately. So once the bill is matured, after 3 months, he will give the rest of the 10% also. For that, he will charge a finance cost. Not actually 10%, a small amount, charge that much, will give that back. Right? There's a credit risk, of course. If the local person, imagine the Sri Lankan person is not paying, entire structure is gone. No. He is bill discounter is, this person is liable to the bill discount. Ultimately, the loss will be to the Chinese person. He doesn't did the transaction. Transaction was with the Chinese man and the local man. So because he had a short-term funding requirement for which he went and asked the bill discounter to discount this and give the money. So he has to settle it anyway. This person has to settle it anyway. So if this person is not paying, that's a problem. So that's why in international trade, all these mechanisms are allowed only if the trust is there. So if these people have done a lot of transactions during the past, he will allow a bill of exchange. If not, if they are doing for the first time, they will not. They will say we just need to do that on the cash basis. Clear? Question number 4. Yes. This is the yes. Phone. Yeah. They have plenty of mechanisms to deal with that. Plenty of mechanisms. So imagine if you are like going for a mortgage, you are taking an official valuation of that property. So if the official valuation of that property is 10 million, bank is restricting your loan value for 75%. So imagine let whatever happen, imagine a flood happens and your property is gone, but still there's a safety margin of 25%. Because whatever the market value of the property, bank will be giving you a loan of up until 75%, not more than that. And for that even you need to take insurance, separate insurance on that property, life insurance on the loan applicant, lot of risk mitigatory mechanisms. So getting into a mortgage agreement, banks won't ever fail. Definitely. So they will send it anyhow. They will send it, settle their dues. Now imagine your property is worth of 25 million rupees. The loan you have taken is 5 million. Bank, if you are not paying the 5 million, if there is a buyer for 7 million, bank will sell. Even though the property is 25 million, do bank care? Bank doesn't care. Bank just need to get the loan repaid you took, not to give you any money. Right? Now, normally, practically that won't happen. That they will be selling it for a market value, but still they are not concerned about giving benefits to you. Right? So they will be selling it just to settle their due. No. You have no authority. Right. Yes, yes, yes. No. They will give. They will give. Now, if the loan amount is 5 million rupees, if the property is worth 25 million rupees, they will send it somewhere around 20 million. They can't have a say. They will have a proper auction. They will have a common auction. They will like advertise in 3 languages in 3 newspapers. Right? 3 languages, 3 newspapers, Sinhala, English, Tamil. That's the rule. So every person in the country is notified that this property is being auctioned. You are the true owner. You are being notified anyway. So any person can bid. Any person can bid. I need this at 20. I will buy this at 21. I will buy this at 22. So the bank cannot be blamed. You are selling it at the highest bid. You are selling it at the highest bid. So whatever the dues bank will recover, along with the interest and everything costs, the rest will be in your account. Act. Of course, covered by the loan applicant. Okay. Any more banking advice is required? Right. TUL have surplus funds that they good that you asked, right? Be really thoughtful about all these. Not learning these things, right? But in the practical world, you should be aware about all this, how these things happen, right? TUL have surplus funds that they wish to invest. Which of the following would be the least risky investment? Least risky in terms of risk. Why? What do you think? Certificates of deposit from a global bank. Not risky, no? Actually, to be honest. Equity shares in a new growing company. My cupcake company. Poor me. Right? Unsecured loan stock. Definitely not. The term unsecured. National lottery tickets. What do you think? Not risky? Very risky, right? So the answer is A. For B, write high risk, high return. In front of B, write high risk, high return. In front of C, write unsecured means more risky. National lottery tickets, high risky. Okay. Right. Then calculating the return from financial products. What's the difference between loans and debentures? There's a clear difference, Vidusha. Loans is for a fixed period, fixed purpose, fixed rate of interest with monthly repayments. Debentures, you are the issuer, there's no any interest, just like treasury bonds. Calculating the return from the financial products. Now you know what are the financial products in the financial market and everything, you are so aware. So equity, when it comes to the equity, the total return to the shareholders, tell me, I told you this. Equity means shares, return. Now don't say dividends, I know that. What are the two types of returns when investing in a share? What? Increase in the share price and the dividends. There are two components, right? We calculated, remember? I know you remember. Both dividends and growth in the share price. Dividend yield. Dividend yield, the equation is dividend per ordinary share, market price of a share. Now the share had the nominal price and the market price both. So dividend yield is calculated dividend per which share? Ordinary share. Remember, dividend per ordinary share and divided by what? Ordinary share divided by market price of the share. This figure looks only at the current dividend, so does not incorporate future growth expectations, right? So how can you measure the return? Only we are looking at dividend yield. This we'll be doing some questions about this. Bonds. There are a number of ways of calculating the yield on bonds. The bill rate, the running rate or the interest yield, both are the same. The gross redemption yield. Now, it's quite straightforward when it comes to the shares. You know, you can calculate the dividend yield, share price increase, or whatever. It's quite straightforward. We also did. So when it comes to the bonds, the other type of the financial product, number of ways of calculating. Now look at this example. Consider a bond with characteristics as follows, right? Nominal value of the bond is $100. Coupon rate is 8%. What do you mean by coupon rate? What do you mean by coupon rate? Coupon rate? I drew that in green color, I remember. Treasury bond. What's the coupon rate? Coupon interest means coupon interest. Bond is for 25 years, right? So when you break down into annual period, so annually you should get some kind of interest. No? So you just like never you like you are going in and investing in a treasury bond and you are waiting for 25 years for the return. Is there a point? No. Okay. So because of that, you are being given annual interest. So that is called coupon interest and the rate is 8. Okay. Coupon rate. Redemption terms to be redeemed at par in 5 years time. Current market value 108.4. This is about a bond. So if you are calculating the bill rate, this is just another name for the coupon rate. Here it's 8%. This rate does not consider the market value of the bond or the capital gain or loss on redemption. Whatever the face value into 8%, you are getting as annual interest. Face value is 100, you are getting annual interest. That is what you call coupon interest. That rate is known as coupon rate, right? It's also known as bill rate. Running yield. Running yield, also known as the interest yield. Interest yield, it's another name. Interest yield and the running yield. The running yield is equivalent to, this is how you calculate. Annual interest divided by the market value into 100. So annual interest you earn. Annual interest. Now, just like a share had a nominal value and a market value, the bond is also having a nominal value or a par value and a market value. Now here the nominal value, the face value is $100. Market value is a separate thing, it's 108. You are getting interest on an annual basis depending on the face value. For every year, the interest is 8%. So simply, what's the interest you are getting for a year? Face value into coupon rate. That is the coupon interest, which is 100 into 8% here. It's $8. Understood? Is it clear, guys? Guys at back balcony. Clear? Okay. So I couldn't make a visit today. This shit is like sounding weird when I'm going. So I couldn't come. Running yield, annual interest is $8 C. Market price is 108.40. So running yield is 7.38%. Understand? Okay. Then if you bought the bond for 108.40, then the annual interest of 8% gives a return of 7.38 on your investment each year. So interest yield is what? I have invested in $100 bond. I'm getting an annual interest of $8 depending on my coupon rate. So that as a percentage, my return is 7.38 on my investment every year. Okay. So in this approach takes into account the market value of the bond but ignores the impact of capital gain or loss on the redemption. That's a separate story. I'm not touching on the capital gain or reduction because this capital gain, this is a longer term one, not like shares. Okay. Bill rate, okay. Running yield or the interest yield, okay. Annual interest divided by the market value. Thirdly, gross redemption yield. Read what gross redemption yield is. The gross redemption yield gives the annualized overall return to the investor and incorporates, this is very important, incorporates both interest and capital gains and losses. Whatever. Both interest and capital gains or losses. Now, just like a share is having the market capital gain and the dividend, this also gross redemption yield is also coming discussing about capital gain plus interest both for the bonds. For the above bond, the gross redemption yield is 6%. How come? 6% gross annualized. Look, nominal value 100, coupon rate 8%. How did I take 6%? I gave it down. Right, we'll go and read. Yes, right. Gross redemption yield is 6%. Keep it for a while. This is lower than the running yield because it incorporates the loss you would make on redemption. You bought the bond for 108.40, but it gets redeemed at par, nominal value of 100. So, nominal value redeeming after 5 years at 108.40, you have the capital gain plus you have received annual interests as well. This 6% how to calculate, I'll tell you. So the redemption yield is the required return of investors, which is determined primarily by their perceived risk but also by interest rates. This then determines the market price as follows. Market price is equal to present value of future cash flows discounted at the investor's rate of return. Okay, it's like this. When it comes to this bond, now this is the bond. Tenor is 5 years. $100 is the nominal value. Market price is 108.40. Every year you are getting $8 as what? $8 as, what's the term? Coupon interest. So if you need to calculate the price of the bond today, how will you be able to do? Imagine you need to sell this bond and you need to sell this and you need to decide on the market price. Now you can't sell it for 100. No? You know it's 108.40, but how can you do? How you do that is, now if you have invested in this bond, what are the future cash flows you will be entitled to? Future cash flows entitled to? Every year you are getting $8. Every year you are getting $8 as interest. So whatever the interest you are getting, so considering the time value of money, if you can discount using my required rate of return, I'm telling you, if I'm investing this, I need 10% return. So considering the 10% return, if I'm discounting all the cash flows of the bond, you may get the market price of the bond. That's what it says. Understood? So we'll be coming into a question where I do the entire calculation. For the time being, to calculate the redemption yield involves, market price is equal to, see the present value. Present value of the future receipts. So future receipts is interest and the redemption proceeds. Right? Interest and the redemption proceeds discounted at the invested required rate of return. So if I discount, if I need a 10% return on my bond, if I discount all the cash flows of the bond using my discount return, my rate of return, you will be getting the market price of the bond. Right? Just understand for the time being. Then, as stated above, the main determinant of the overall yield to an investment is their perceived risk, which is, I told you about several factors which I need to consider when I'm selecting a financial product. Firstly, it was yield. Secondly, risk. So, main determinant of the overall yield to an investor is their perceived risk. So, I'll be looking at the risk, right? Rather than the return, I'll be concerned sometimes about the risk, isn't it? Like when I'm going and investing in a treasury bond, will I be concerned about the 0.5 to 1% rate in the required rate of return, or else the risk? What's the factor I'll be looking at? Definitely risk. Whether I'll be getting my money back. This in turn determines the market price for the bond or share. Suppose a company is currently paying a dividend of 20 cents per share and is expected to do so in the future. If the share price is $1, then the net dividend yield would be 20%. Dividend yield I gave you how to calculate. Suppose that adverse environmental factors then causes investors to consider the shares more risky, so that they now want a return of 25%. So whatever the return they request in the shares or bonds, whatever, is extremely dependent on the risk. So if I'm going and investing in the shares of a company, if that is less risky, the share price would be less, isn't it? So if the business is high risk, the return I'm expecting is high. So if I'm investing in a risky venture, right, very risky venture, I need huge returns. So similarly, suppose that adverse environmental factors then cause investors to consider the shares more risky, so that now they want a return of 25%. Previously, what was their return? It was 20%, right? Now they need 25%. If the company still pays 20 cents just like previously, just like they previously did, then the only way the yield can rise to 25% if the share price falls. If the share price falls, now you have, when it comes to a return from a share, you have two factors: share price and the capital gain. So if due to the environmental factors or whatever, they keep the return, the 20 cents paid to the share constant, to match the same, what will need to change? If I write it like this, if I write return from a share, I can write dividend plus share price rise, right? That's the equation. Whatever the return is equal to both of these. So if the dividend is kept constant, that won't change. If the dividend is kept constant and that won't change, if you need to increase the return, from 20 to 25, what's the sole factor we should change? What's the sole factor? Now this is constant dividend, 20 cents. So to increase this to 25, what needs to be changed? Share price. Clear? So that is what they see. Then the only way the yield can rise to 25 is if the share price falls. So net dividend yield calculated, 25 is the return required. Previously it was 20. Now 25 is the required return. 20 annual dividend won't change. What changes is the market price of the share. So market price, you can calculate, this would give a revised market value of 80 cents. Understood how that happens? Right? Anybody? Right. Risk determines the required return, which determines the market value. Very important. Right? Risk determines the required return. Previously, the shareholders wanted 20%, but due to some environmental factors, risk enhanced. So because of the risk enhanced, investors wanted higher return. Risk determines higher return. So that determines what? Market value of a share. So in the share market value changes, fluctuates depending on what? Depending on what? Risk of the company. Is that clear? Everyone? Yes or no? You say yes. Okay. Good. When I say yes, you say yes. When I say no, you say no. All right. Right? Then the terms. So I'm not doing any further calculations of these two sums because we have plenty of questions at the end, right? So I'll be doing it. Then I'll be explaining. So see this. Term structure of interest rates and the yield curves. Some people believe that the annual interest rate on a loan remains the same regardless of the period of the loan. Is it? What do you think? Some people believe that annual interest rate on a loan remains the same regardless of the period of the loan. Are you inside this, some people? Are you sleeping, guys? Do some gesture, move a bit, smile, do whatever. It's the last 15 minutes now, right? Nothing changes. Like everybody is like this. I continue to like scream and scream, say yes. That nothing changes, right? I know it's difficult. I know it's hard to like concentrate, but still we'll have to do, right? Can't tell. So if the interest rate charged on a 2-year loan was 5%, it would be 5% on a 6-year loan of the same risk class. So we understood that when it comes to the shares, whatever the market price is dependent on the risk. Similarly, when it comes to the loan market, debt market, similarly, the interest rate is quoted for the risk class. Right? That's what I said. When it comes to a personal loan and when it comes to a housing loan where we have kept a property security on which the bank will charge a lower interest rate. But property housing loan. Because why? Risk is less. For the bank, the risk is less. They charge lower interest rate. No. No, depending on the fact that in the general terms, credit cards are offered. Credit cards are being offered considering your credit worthiness. If we can't establish your credit worthiness, only we will be taking a fixed deposit. That's a security. That does mean if you can't pay, if in one instance, like mostly for the elderly people older than 60 years of age, if you need credit cards, we won't allow because you can't take the salary receipts of your grandma, no? Right? So we will be keeping a fixed deposit and giving the credit card. But the misconception is, although you keep the fixed deposit, that does not mean that the risk is less. Right? You go into a bank and ask for a loan and you are keeping a property security which is from, imagine, next to one goal face. You want 3 purchase of land next to one goal face. The land value will be billions. You keep, but the bank won't care. Because why? When the banks are lending, banks doesn't expect that property to be sold. Banks are concerned about your repayment. Whatever the property or whatever you are taking as security is an additional comfort only. Clear? But you might keep a property as a security from Colombo 7, 100 million worth of. But if you can't repay, now you are not working. Think like this, you are not working. You are not working and you are not having a proper monthly income. But you're going into the bank and saying, look here, I'll give my property. This is from Colombo 7, 10 purchase, 100 million worth. Give me a loan. Will the bank give? Will the bank give? What do you think? Guys, what do you think? Bank will not give. Bank is not a land sale or a property sale company. Bank is primarily concerned about your credit worthiness. So if you have a salary of 350,000 per month, bank will give you a loan. Because why? Bank can assure from your employment you are getting income. But if you don't pay as an additional cushion, you can have a property. That's it. Understood? So basic factor is credit worthiness. So even though we give a credit card keeping a fixed deposit, risk is there. Understood? Fixed deposit. Now, even though you keep the fixed deposit, you think now you use the credit card. right? Today you use the entire limit of the credit card, next day you are gone. You think the bank can finish off that fixed deposit like that? Bank properly needs to inform you that we are doing this, we are settling this, and likewise. Even though you keep property, even though you keep fixed deposits or whatever, those are additional cushion, additional comforts only. What the banks are concerned is about your credit worthiness and repayment capacity to pay. Did I answer your question? Right. What I was talking about then? Interest rate charged on a loan was 5%, then it would be 5% on a 6-year loan even. No matter what the tenor is, rate is same because why? The risk. However, lenders in the financial markets normally demand higher interest rates on loans as the term of the maturity increases. That is, there is a term structure of the interest rate. Yield curve shows this relationship important. When you go into the bank, now understand, good that he's asking these questions. Like if anybody is having questions like that, ask, right? If any questions are there, you can ask, right? I can clarify. When you are like going into the bank and asking for a loan, for a 2-year loan, for a 5-year loan, and for an 8-year loan, interest rate, what will happen? Why? Yes, repayment longer. What happens then? Risk is increasing. What's the risk? That's okay. What's the risk, guys? I'm the bank and I'm giving a loan for 2 years. I'm giving a loan for 5 years. I'm giving a loan for 8 years. What's the risk I'm having? Yeah. So the bank, obviously, so one point is that bank doesn't want your property to be purchased, right? Bank needs the loan to be repaid. Why? Banks are lending whose money? People's money. People go and deposit to the bank, and the bank is giving that money back to some other people. So the deficit parties, right? So the bank would like to have the repayment, not the properties, right? Not the properties, they need the repayment. So that repayment, bank would love to have the repayment as quickly as possible. So if I give some money to a friend, if he agrees to give me in 2 months, I would like that. So if I give the money and he is giving me in 5 years, there's a huge risk. So I'll have to keep that in my mind, whether this idiot will be giving me, so whether this person will migrate, what will happen, will this person die, right? He's like drinking on a regular basis, so he will die without giving me money. Things do come into play. So imagine that is my money given to a friend. So think from a bank's perspective, others' money given to someone else. What's the risk then? I'm concerned giving my money to my friend, whether this bugger would pay or not, or die. Like he is walking all the time in the road, whether a vehicle would go, right? What will happen, right? My money. That's okay. He dies, my money. Isn't it? So think from that perspective about a bank. Bank is giving loans from whose money? People's money. So liable to every citizen. So you come and deposit 100,000 rupees in the bank. The bank manager has given a loan. Then the next day you think, no, I don't want to put in this bank. Why don't I put in the other bank? So I'm going to the bank manager. I need my 100,000. So can the bank manager say, you fool, you yesterday only you deposited. I gave a loan from that. You come back after 5 years. I can't wait. Sir, I can't give. You come back after 5 years. Can the bank manager say? No. So imagine the level of risk. Can you understand? The banks, right? So accordingly, banks would want you to pay as early as possible. You take a loan as early as possible. If you can pay, that's the better. As a result, when you plot the return, and the interest rate, years to maturity and the interests charged, years to maturity and the interest charged, the graph is like this. This is called the yield curve. What it is called? Yield curve. So for 3-year loans, what's the rate? You can't see. Okay. 3-year loans, 5%. 5-year loans, 6%. Like somewhere here, 8-year loans, somewhere here. So the interest rate charge varies with the term to maturity because of the risk. Then the longer the term of the security, the higher will be its gross redemption yield. Don't have time to explain that now. Okay. I just need more time to explain it. So, no, I'm not finishing off. I'm going for a question. Wait, I have 4 minutes. You like. Right. Question number 5. Question number 5. Question number 5. Quickly give me the answer. You might be thinking, why should we give quickly? No, we shall do leisurely so that we can do one question and go. I know this. I was a student as well once. Right. So Wisdom has had uploaded, it seems, some questions from Unit 1, is it? Some had said, some had done. So there was one question, no? There was some error in the answer. We'll see about it. Everybody do the questions and come. So if there have any clarification required, you can ask. One question is, the answer is wrong. Yeah. Is it 19? Okay. Right. Don't blame me. I didn't give you this thing. No, it's from Wisdom. You don't know who prepared. Right. So a company has shares in issue with $100 nominal value and a market price of $80. Okay. Dividend is 5%. This generates a yield. Simple. Answer A, B, C. Okay, D. Right. You may, right. Answer is like this. Put a star mark here and write yield. Yield gives the relationship between income derived and price paid to acquire it. Yield gives the relationship between income derived and the price paid to acquire it. This is the answer, 6.25. Okay. Right. So I'll like stop from there. So you just do the rest of the questions and come. I'll be spending like a half an hour for the questions next day and we'll be finishing this tute. They had uploaded the next tute as well. Was that there? LMS? Next one? Should be, right? They'll upload it. So the financial systems part 1 will be completed by next week. Okay. Okay. Thanks for joining. You can leave. Where's your friend today? See. Is your friend? So anybody have questions, anything to clarify, you can come. I'm here. Those are joining online, if there's anything to clarify, you can put in the chat box. Thank you.